In the previous conversation, we introduced currency and the idea of inflation and deflation, and defined inflation as too much money relative to goods, and deflation as not enough money relative to goods, so that the prices had to adjust to accommodate the fact that there was either too much currency available or not enough currency available, and that changes the value, the purchasing power, the worth of currency. And I also mentioned that monetary policy is focused on trying to stabilize and maintain a steady currency value. And so it's worth talking about how monetary policy plays out, and talking about what that looks like in the United States, where currency policy is handled by the Federal Reserve, which is the central bank for the United States, and sets currency policy, essentially controlling the supply of dollars in circulation, trying to make sure that there's enough dollars in circulation to meet current economic activity, not over, flooding the economy with dollars, but also making sure that we don't have deflation, don't have a shortage of dollars. And the primary tool that the Federal Reserve uses to do that is the Fed Open Markets Committee. There's a number of other different levers and strategies and tools that the Federal Reserve can use, but primarily in normal circumstances, when we're not facing sort of a great recession or a depression, normally currency policy is handled through the Fed Open Markets Committee, which essentially indirectly sets interest rates by buying and selling treasury bills, forcing the interest rate that the United States government has to pay on those treasury bills up or down. And so you might say, well, where does the Federal Reserve get its money to do that? Let me tell you sort of a convoluted story. So the United States government typically, most months, runs a deficit, which means that there's not enough money coming in to pay for bills that the United States government has incurred. So in order to cover that gap, the federal government issues debt, which means that they have to call together potential investors and bankers and say, would you be willing to lend us money? And what are the terms under which you're willing to lend us money? Ideally, the federal government would like to lend money at zero interest rate. That would be great. Most banks, most investors are not willing to give the money to the United States government to borrow, to lend it to them at that interest rate. They're likely to ask for a higher interest rate. And so there's something of an auction process that goes on. But sitting in the back of the room is the Fed Open Markets Committee, which has preferences over what it wants to see for those interest rates. And so if lenders are not, offering to lend money to the United States government at a rate that the Federal Reserve sees as appropriate, the Fed will step in and say, we'll borrow or we'll lend you all the money that you need. We'll buy up these treasury bills. And after the auction is over, the Fed, walks up and writes to the Treasury Secretary a check and says, hold up, don't cash it quite yet. And metaphorically, the head of the Federal Reserve runs back to his or her office, calls up the Treasury Secretary and his or her office and says, I just wrote you a check to lend the U.S. government money. The Treasury Secretary will say, oh, yes, thank you very much. And the head of the Federal Reserve will say, so what I need you to do is to walk down the hall and turn on the printing press and print me, however many hundreds of millions of dollars to cover that check, because I don't currently have any cash on hand. The Treasury Secretary will walk down the hall, flip on the printing press, print the cash. The cash gets taken over to the Federal Reserve. The check gets cashed. The cash that's taken to the Federal Reserve gets returned to the Treasury, and the U.S. government can pay bills. That's a very convoluted way of doing that. But the critical piece is that the Treasury Secretary doesn't get to walk down the hall and flip on the printing press until the head of the Federal Reserve says, I want you to print this amount of currency. That the decision to print currency is held by the Federal Reserve, and they'll make that determination based on whether they want to step in and lend the U.S. government money at a lower interest rate than what markets are supplying, or maybe they'll hold back, and maybe they'll even compete with the U.S. government and tell bankers, so you could lend money to the federal government at 4% interest rate, but I'll lend, you can buy the exact same treasury bills from me that I have stockpiled over the years, and I'll give you 5% on them. And so if the U.S. government wants to borrow the money that it needs to conduct its operations, it has to match that higher interest rate that the Fed Open Markets Committee is able to essentially set. And so it's through that process that the Federal Reserve is able to control the interest rates on U.S. government debt, and at the same time make a decision about whether or not it wants to print more currency and put more currency in circulation. And that has a whole host of effects. So when the government borrows money, it's essentially pulling money out of circulation that could be used in the private sector. And it's putting it into treasury bills. It'll get redistributed in federal government spending, but by pulling money away from the private sector and by changing those interest rates, in particular by changing those interest rates, the decision to manage the supply of money has all of these other effects on the larger economy. Because if interest rates go up on federal government debt, those interest rates are going to be appealing to bankers who want to get high interest rates when they lend money. If interest rates are pushed down, bankers are going to be less likely to want to lend money to the federal government, because a 1% interest rate, a 1% return isn't all that fantastic. But that's going to trickle down and have effects for how you and I get access to money. Because when I go in to get a car loan or a bank loan or a business loan, they're going to look at me and they're going to see me as a far greater risk of default than the federal government, which has a printing press and has a Federal Reserve. And so if the Federal Reserve has decided that that they're going to increase interest rates that the federal government pays on its debt, banks are going to want to give money to the federal government. I'm going to have to pay a much higher interest rate for my mortgage or for my business loan if I'm going to pull money away from the public sector from being lent to the government and convince banks that they should lend it to me, a much greater risk of default. And so we oftentimes pay close attention to these interest rates and make a differentiation between what's sometimes called tight money policy and loose money policy. Tight money policy being associated with higher interest rates. And so when you have high interest rates, again, the Federal Reserve is not printing money. It's raising the interest rates that the federal government is going to have to pay to borrow money. And because it's not printing money, you're unlikely to have inflation. It's possible you could even have deflation if the economy continues to grow and there's not the money supply is not being increased. You're likely to have more foreign investment coming in because investors, not just within the United States, are going to look at those higher interest rates and say that's a pretty good deal, but all over the world, people are going to look at those higher interest rates and say, wow, the United States is paying 5, 6, 7% interest on really safe investments. We should be investing there. We should be lending money to the United States. And so this ends up being really important when we talk about the global currency system, because changes in interest rates, a tight money policy or a loose money policy set by the Federal Reserve or by the central banks in other countries can have these cascading effects in terms of how it moves money around and what's perceived as a good investment or as giving a good rate of return because of shifts in these policies and these decisions. A tight money policy also has the effect of slowing the overall economy. So as interest rates go up, banks are going to be less likely to lend to you and I, which means businesses are going to have a harder time getting the money they need to expand. They're maybe going to hold off on building that new factory. It's going to slow economic growth and will probably, if you increase interest rates high enough, will drive up unemployment. And so there's these various different effects that come from driving those interest rates up. Now, if you lower interest rates, if you have a loose money policy, that's potentially good for businesses in that they're able to borrow money. They're able to expand that factory. They're able to add, more employees. Houses are easier to build, and so you get a construction boom, all from a loose money policy. It's going to be less appealing to international investors who might look elsewhere. So you're going to have less foreign investment coming in. But the big risk of pursuing a loose money policy is that in order to do that, the Federal Reserve is buying U.S. government debt at a rate below what the market is likely willing to pay for it and printing money to cover that as a result. which means more money is going to circulation, which means you can get inflation, which is potentially bad. So there's oftentimes this trade-off in setting monetary policy between keeping inflation low, which is oftentimes a desirable thing, but potentially increasing unemployment. And that really creates this core tension at the heart of setting monetary policy. And in fact, written into law, in the law that creates the Federal Reserve, is a dual mandate, that by law, the Federal Reserve is required to set monetary policy in a way that maintains low inflation and low unemployment. What that means has changed over time. Typically for the last 20, 30 years, the Federal Reserve has shot for about a 2% inflation rate and 5 to 6% unemployment. Recently, I think that's maybe bumped up to about a 3% inflation rate that they're willing to target. They're willing to accept a little bit higher inflation to hopefully bring unemployment down a little bit. But there's definitely that trade-off. And at different points in time, the Federal Reserve has sort of treated those targets in different ways. In the 1950s and 60s, coming out of World War II, the United States had a lot of debt. And one of the ways that the Federal Reserve dealt with that was by tolerating a slightly higher inflation rate, 5 or 6%, and getting a lower unemployment rate, pushing it down to around 2%. In the 1970s, when you combine that policy along with an oil shock, you end up with much higher inflation rates that were considered too high by the Federal Reserve. And so they really tightened things down and brought that inflation rate down closer to 2 or 3%. Not every central bank has a dual mandate. I guess famously or importantly, for a conversation we'll be having later on, the European Central Bank, written into its charter, only has a target to maintain low inflation, that its job is to maintain a stable currency value, and it doesn't care about unemployment, or more precisely, unemployment is not something to be factored in when considering how to set monetary policy. So not every central bank balances these things intentionally or balances them in the same way. And I think it's also important to point this out because different segments of the economy are going to have different preferences for a tight money policy or a loose money policy. If you're a worker, you probably are favoring a loose money policy because you probably have some debt and a little bit more inflation is going to be desirable to maybe reduce that debt, to make it a little bit easier to pay off. You're also going to like an environment in which unemployment is very low, in which there's a demand for workers, in which if you get fired or you decide you don't want to work in your job, there's lots of other jobs available that you can take up. That's a desirable environment from a worker's perspective. But if you're a banker or somebody who has huge piles of money, that's less desirable, right? That a loose money policy means inflation is potentially higher, which is bad for your big piles of money. It means that if you don't do something with those piles of money, the value, the purchasing power of those piles of money is going to be eroded. Deflation might even be a desirable thing because then you can just sit on your big piles of money and the value increases without doing anything. And again, sort of with a loose money or with a tight money policy, potentially you could lend money to the federal government at a very generous interest rate, and that's incredibly safe. And so that's maybe a more desirable monetary policy for different segments of the economy, which is one of the reasons why a dual mandate for the Federal Reserve ends up being really important in terms of not just stabilizing currency values, but also thinking about how that stabilized currency value is affecting the larger economy.